The West Texas crude oil rallied by close to 10% at the start of today's Asia session, hitting a 4-year high due to this ongoing US-Iran conflict that may extend after both sides decided to extend hostility over the weekend, where US and Israel strike Iran's targets on Saturday. In today's early Asia session, safe haven demand is in play, where we start to see across the board sell-off in the major global stock indices, with the S&P 500 and the Nasdaq 100 E-mini futures down by around 0.7% intraday. Interestingly, the US dollar strength at the start of today's Asia session managed to find resistance at a key short-term resistance level that is being seen on the US dollar index. And interestingly, commodities related currencies like the Aussie dollar managed to find support right exactly at the 20-day moving average. Very good morning to all and welcome to today's highly volatile session. And today's daily dose, we will cover a full suite of the latest intraday technical outlook on the broad-based cross asset classes. Very good morning to all and welcome back to today's daily dose, which is also a brand new trading month, 2nd of March 2026, Monday. So before we kickstart, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for information purposes and it's not investment advice. Past information is not representative of future results. All right, so here we go. So let's have a quick recap what has taken shape in the last 48 hours. So in the last 48 hours, let me very quickly bring you through the Bloomberg news flow over here. So basically what we could see over here is that in the last 24 hours, US and Iran is now in a kind of a mini war over here. So the issue started on Saturday, where US together with Israel has decided to strike Iran targets, despite the fact that open negotiators open a door for a potential diplomacy in this week, where they are trying to piece together another round of negotiation talk, where last Thursday the talks fails to make any breakthrough. But with this strike by US and Israel, that actually closed the door of further diplomacy. And what's interesting over here is that we start to see a round of retaliation attacks by Iran over the weekend, bombardment on US military assets that are located across Middle East, including UAE and even the safe haven Dubai over here. So at the start of today's Asia session, we see WT crude oil and Brent jump as much as 13% before padding off gains. And we also see this Trump himself over the weekend saying that the US will continue bombing Iran until his objectives are being achieved over here. And also Trump has confirmed the death of Iran's supreme leader, which is the rather charismatic leader that is controlling the military and politically over the weekend. And the thing over here is that he called for Iran military and police to surrender for full immunity or face certain death. So it seems to us that both sides are now in a prolonged conflict, potentially reducing the odds of symbolic attacks akin to last summer. All right, so that causes the so-called the safe haven play together with the oil prices rallying up to 10% in today's Asia session over here. So let's take a look at very quickly the intraday movement. So you see this US oil over here. So come on. Yeah, so at the start, it gap up close to about 10%, pair down it gains, now hovering at 4% over here. For gold XAU/USD, the gap is lesser. It pair up to about 2%. It gap up to 2%. Now trading at 1.4% over here, and is right now trying to trade above its intraday low that is being made at around 5,307, now trading up at 5,352. And across the global stock indices, we start to see the risk of impact on the S&P 500 futures over here. So both the E-mini futures and the Nasdaq E-mini futures are down by negative 0.7% over here. All right, and that has a negative feedback loop across Asia as well, where the Nikkei 225 is down by negative 5%, given the fact that Japanese are considered as a key oil importer rather than the oil exporter. So therefore, potentially higher oil prices could have a negative impact on the Japanese economy, and in some form creating a negative feedback loop now on the Nikkei 225. And very similar on the Hang Seng Index as well. So given the fact that China is also being a huge net importer, and primarily they import their oil from Iran, Russia, and in some form very little from the US. But despite the fact that there is a risk of the oil prices spiking up due to the closure of the Strait of Hormuz, if Iran decided to use that as a strategic point to actually extract negotiation in form of an indirect negotiation between this US and Iran conflict. But nevertheless, traders now are having a rather have safe haven play first. That means we talk about pairing off a risk position before we start to talk later. So there's a negative feedback loop on the Hang Seng Index, down by negative 2%. And even the China A share market is also negatively impacted as well, but of a lesser magnitude, down by negative 0.4% for the CSI 300 over here. And the narrower China A50 benchmark index is down by negative 0.13%. And all next to other Asia Pacific stock market over here, the ASX 200 is having much more lesser losses, down negative 0.36%, due to the fact that there are various component stocks within the ASX 200 that is outperforming, with the likes of Rio Tinto and BHP Billiton that is staging a positive moment right now due to higher commodities prices. And the Kospi is closed for a public holiday today. Over in STI, we are being a small exposed open economy, and given the fact that we also pretty much dependent on oil, being a net oil importer, so that could actually create a knock-on impact in terms of our cost of production, cost of living, if oil prices will continue to be firm, and there's a risk of it hitting to about what, $80 per barrel or even $90 per barrel. So that should explain why the STI is being underperformer today among the Asia benchmark stock indices, down almost 2% right now, down at negative 1.8% over here, down negative 1.8%. And with the fact that several key component stocks are pretty much dependent on the economic cycle. So with a higher oil prices, potentially it could then consumer spending due to the higher cost of living, and that created a negative feedback loop on the banking stock and also the airline stock SIA, which is also a key component stock within the STI, given the fact that higher oil prices will potentially narrow down the profit margin of airline stocks like SIA, Singapore Airlines over here. So onward next will be the FX market. So the FX market will be rather interesting. So if you look at the 5-day rolling performance of the US dollar against other major currency as we're speaking right now, they are rather flattish over here. So traditionally, we tend to see a bit to safe haven in terms of the US dollar, when we start to see rising geopolitical risk tension, but this time around it's not playing out. So what I suspect is that South American narrative is still pretty much intact over here, given the fact that market is viewing that the American himself is undergoing this rather aggressive foreign policy. So that could lead to a further debasement trade taking place, where gold price continues to go up. So that could also potentially put a dent on the US dollar strength. And what's interesting, if we were to do a one-day rolling performance, taking into the last 24 hours, we see the dollar weakening against the commodities-related currency, which is the Aussie dollar. So the dollar Aussie, based on a one-day rolling performance, is down by -1%. So like I mentioned earlier on, the Aussie dollar, yes, despite today's sell-off on the intraday basis, it managed to find support. And on a one-day rolling performance basis, the dollar versus the Aussie means the dollar is down by almost -1% over here. So despite the fact that the Aussie dollar sometimes is considered as a higher beta currency that is sensitive to the risk-on, risk-off movement in global stock indices, but this time around, the Aussie dollar has transformed itself more related to commodities prices, and also given the fact that the Australia Central Bank is on a path of a potentially tightening cycle rather than an easing cycle, as they are pretty much fearful of a increase in inflationary pressure in the Australia economy. So that actually also explained to us the Australia economy also tend to benefit from higher we call it minerals, higher commodities prices as well, that is now supporting the Aussie dollar strength against the US dollar, or with the US dollar weakness against the Australian dollar, which is down by -1% as we are speaking right now. And onward next to the technical configuration of the US dollar index. So the US dollar index also continues to track in this 50-day moving average. So in today's Asia session, it tried to do a challenge at the key intermediate resistance of 98.05. So this is the US dollar index in a daily chart form. Means one candle equals to a day price of action, which is close to about it from 6 a.m. Singapore time all the way up to 5 a.m. US session close. So what we could see now is that the US dollar index is trying to shape a impending daily shooting star. All right, so this shooting star will only be confirmed upon 5 a.m. Singapore time tomorrow, Tuesday, upon the closure of the US session. But nevertheless, we start to see the US dollar strength being kept at today's Asia session after the test of 98.05. So giving me to have an opinion that the sell America narrative is still intact. That means, i.e., the dollar strength is also being kept by the strength in the gold prices as well over here. All right. So then let us take a look at the latest so-called news flow that is coming out on this Iran-US conflict over here. So what you could see over here is that Trump seems to be giving a olive handshake over here. So there's this Iran security chief pushes to resume US talk, as reported by Wall Street reports over here. Then Trump also mentioned, there's this headline here, is that US is open to dropping sanction if new leader pragmatic, this by Trump himself. But later I'll share with you what are the key levels to look at, because right now, given the fact that things are very fluid, we got to take things one step at a time over here, and also respect the very short-term key levels. So if the key levels holds over here, whatever news flow that are coming up is considered as noises over here, because things are rather fluid over here. So the key thing over here is about the Straits of Hormuz. So this Strait of Hormuz is actually the global oil flows choke point, and it's very, very close to Iran. So previously, whatever conflict that Iran has with Middle East, they were actually threatened to shut down the Strait of Hormuz. So if this Strait of Hormuz is being shut down by Iran in some form or another, that could potentially disrupt global oil flows over here, and that could create a positive feedback loop in oil prices as speculators continues to pile in net long bets that oil prices may remain on a firmer basis. And worse still, if Iran continues to launch attack on Middle East and targeting Saudi Arabia oil pipelines, that could also potentially disrupt oil supply as well, given the fact that OPEC Plus yesterday decided to increase oil output starting next month higher than expected over here. All right, so that covers the first segment of the daily dose. Before I touch on the second segment of the daily dose, let me share with you something very important pertaining to the Federal Reserve interest rate policy going forward. Okay, so one of these longer term chart I'll share with you is the interlink between this oil prices, WTI crude, which is highlighted in green, and as well as this light blue line and dark blue line over here, which is the 10-year US break-even rates and the 5-year US break-even rates over here. Let me expand it. All right, over here. All right, so this 10-year break-even rate is considered as future inflation expectation. Okay, let me put it everything in order. Okay, so for you guys to have a better look at it. Okay, let me adjust it. Okay, so this crude. Okay, so WTI crude oil price is in green. And you notice that the WTI crude oil price has a rather significant direct correlation with the movement of the US 5-year break-even in dark blue and the US 10-year break-even inflation in light blue over here. So both of them, based on last Friday trading prices, are at 2.4% and 2.25%. So think of it as these are based on traded instrument extracted from the US Treasury inflation protection bond. All right, so it's a tradable instrument inferred from traders' price action behavior. So the 10-year break-even inflation is something like what is traders expecting US inflation will be 10 years from now, and the 5-year break-even is what are traders expecting US inflation 5 years from now, okay, based on the current price action. Okay, so based on last Friday price action dipped down slightly, but still hovering above the long-term target of 2%. So bear in mind that the Fed always have this long-term inflation target of 2%, therefore desirable. So this 10-year and 5-year break-even has been sideways and above this 2% level since September 2024. And if oil prices continue to spike up over here, given that it has a significant direct correlation with the 5-year and 10-year break-even inflation rates, your 10-year and 5-year break-even rate may face upside pressure as well. So once this 10-year and 5-year inflation rate goes up over here, that could put the Fed in a very tight spot. That means we know that the US labor market is not really that robust and fantastic. In fact, it's rather lackluster, and some we call it a data point links to a shrinking labor force. But however, with inflation expectation picking up, they may not be able to cut rates as aggressively. So they may actually hold rates at this level for a period of time before oil prices stabilizes, and that causes potentially to see some form of stabilization in the 10-year and the 5-year break-even rates as well. So far, if you look at the Fed funds rate futures contract, based on the current price action right now, which is not very liquid, so we got to wait for until the US session opens before we get a better picture of what's going on. So we know that for the upcoming 18th of March meeting, market participants expecting the Fed to remain on hold at 3.5% to 3.75%, a high chance of 95%. And market continues to see in the summer months of 17th of June and 29th of July FOMC meeting around 60% and the 95%, 97% chance, very high probability around the at the 29th of July to kickstart another interest rate cut. So that will be the 4th cut so far in this ongoing interest rate cut cycle that kickstarted late last year to bring it down to 3.25% to 3.5%. And also another 87% chance on the 10th of October meeting to bring it down by another 25 basis points to 3% to 3.25%. And that will be it for this year. All right, because markets participants expecting the Fed, the last meeting on 12th of 9th of December 2026, 66% chance to be at 3% to 3.25%. So that only imply 2 interest rate cut. But this odds here could change today. But given that this pricing is based on the current Globex futures market, which is trading right now on the Fed funds futures, but liquidity is rather low during the Asia session. So a better picture will come once the US session opens today. So market participants with very close eyes on the Fed funds tool over here. So if we continue to see a further reduction on interest rate cuts odds as being priced in by the Fed Fund Watch tool, that could imply a lower liquidity environment, and that doesn't potentially gel well for US stock indices as well, given the fact that we last 2 weeks or so, we start to see this AI scare disruption trade play taking hold. All right, so now that covers the first segment. Now let me move on to the second segment over here, which will be this intraday technical outlook segment, all right, on the broad-based cross asset classes. So with that, let me expand my screen. All right, so let's start with the FX market first over here. All right, so given the fact that the US dollar remains on resistance, the US dollar index remains on resistance, I will not be so we call it have a very strong view that we may start to see dollar strength coming back, perhaps more of a messy sideways range configuration again on the very shorter term. So for the euro dollar, last Friday we do have a mild bullish bias holding above 117.40, 117.28, where price action managed to hold in today's Asia session. So this mild bullish bias continues to take hold for today, with the range resistance coming in at 118.33. 118.60 for now over here. So likely it continues to toggle within this minor range configuration since the low of 19th of February. So only a clearance above 1860 level, which is very close to the which is also close to the 20-day moving average. So that potentially will see a further potential push up towards the next intermediate resistance level, which is the minor swing high of 12th of February at this 118.87. followed by 119.27, which is much more significant. 10 at the 9 and 11 of February minor swing high that kickstarted this recent leg of minor corrective decline that put it down to the minor swing low of 20th of February. So let me put it in writing. So this will be at 118.87. All right. Only a bearish breakdown below 117.28 that would negate or invalidate this mild bullish bias to open up scope for further weakness towards 116.73 and 116.32, which confluence with the area of the 200-day moving average over here. Next up will be the sterling pound. So the sterling pound against the dollar in today's Asia session, it gapped down and right now is trying to trade back up above the 200-day moving average again. And what we could see now, there is a bullish divergence that is being formed on the hourly RSI. So a rather mixed element, and also given the fact that the US dollar index can't surpass the resistance level over here, which I highlighted earlier at 98.05, and also forming an impending bearish daily shooting star candlestick right after the retest of the downward sloping 50-day moving average as well. So with that, I would not have a bearish stance on the sterling against the dollar. So instead, I will have a neutrality stance for today. So neutral between 134 figure level and 135.23. A clearance above 135.23, which is also potentially very close to this upper limit of this minor descending channel that has been in play. So medium-term descending channel that has been in place since 28th of January, that could see a bullish exit potentially from this minor corrective decline sequence that has been taking place since late January this year. All right, over here. Okay, and that could potentially open up scope for the next intermediate resistance to come in at 135.88 in first step, which is very close to the 20-day moving average. So that's for the sterling dollar. Next up will be the Aussie dollar. So like I mentioned, the Aussie dollar continues to outperform over here, with it going back up above the gap down that is being formed in today's Asia session, and right now hitting the key resistance level of 71.40 over here. So with that, first support level to watch 70.70, and the pivotal support level will be 70.35, 70.25, which is the minor swing low area of 20th of February and 24th of February over here. A clearance above 71.40 potentially could see the next resistance coming in at 71.75, followed by 72.10, which is a 0.764 Fibo extension of this ongoing impulsive minor upmove sequence from the low of 6th of February. And 71.75 is a graphical, also a graphical minor congestion area of 8 and 9 of June 2022 back then. However, a bearish breakdown below 70.20 that would invalidate today's bullish bias on the Aussie dollar to see a sudden push down with another corrective decline sequence unfolding, exposing 69.80 in the first step, which is the minor congestion area of 7th of February and 5th of February and 6th of February over here. And if you do the Fibo retracement of this last push up from 6th of February all the way up to the 12th of February, that also coincide very closely with the golden ratio of 61.8% at 69.90. Failure to hold above 69.80 will see a deeper minor corrective decline sequence / pullback unfolding to revisit the rising 50-day moving average that is confluencing with the 6th of February and this congestion area here of 23rd of June and 23rd of January and 27th of January this year at 69.07, 68.90. So that's for the Aussie dollar. Next will be the dollar yen. So the dollar yen didn't surpass our short-term pivotal resistance that we have on last Friday, which is also the minor swing high of 25th of February, staging a negative so-called bearish reaction of that. So no change, continue to have a mild bearish bias on the dollar yen. 56.83 short-term pivotal resistance level. First support level to watch will be very close to the 20-day moving average, which is this congestion area here of 20th of February and 24th of February at 154.95 / 154.65. However, a squeeze up above 156.83 will negate this mild bearish bias on the dollar yen to see a squeeze up to retest the medium-term pivotal resistance level at 157.50, which got rejected after it broke down on the 23rd of January previously over here. So that was 157. Then after that, it retests and shaped that last recent decline all the way down from 9th of February to 12th of February after the ex-post Japan snap election took place. All right, so that's for the dollar yen. Now, next up will be the global benchmark stock indices intraday technical outlook. Let me start with the Asia Pacific region with the Hong Kong 33 over here. So the Hong Kong 33 broke down below the swing low of 30th of February and also the 27th of February over here. So with that, there could be a risk that it may revisit the 200-day moving average again over here. If we go all the way down, this will be the minor swing low of 29th of December and 2nd of January. There could be a risk of visiting it. So then also the RSI also has broken below a parallel ascending trendline support. Potentially there could see some form of weakness coming into play. So with that, I will have a very tight pivotal resistance for today. We're using the gap down over here, that which is also the 50-day moving average. Right, at 20, give me a minute. Okay, 26,500. Right, let me put it in writing. 26,500. Okay, 26,500 short-term pivotal resistance level over here. A breakdown below 25,820, which is managed to form some form of support right now, exposes the 200-day moving average at 25,530. So upon hitting 25,530, I'll be on the lookout for a potential bullish reversal candlestick. And if you look at the 25,530, it also confluence with a Fibo extension level in this ongoing minor corrective decline since the high of 29th of January 2026, which is the high of this year. Okay, that coincides with the also almost the one-time Fibo extension as well. However, if price action continues to rally and clear past 26,500, that would invalidate today's bearish bias view on the Hong Kong 33 that's representing the Hang Seng Index to see a squeeze up towards 26,280. Above it potentially sees the range resistance that has been in place since 23rd of February, got rejected on 26th of February at 26,100. Upper limit will be this minor swing high as of 12th of February at 27,228. All right, so that's for the Hong Kong. So that's for the Hong Kong 33. Next up will be the Japan 225 that is representing the Nikkei 225. So the Japan 225 previously, we are looking to be bullish at this 57,140 short-term pivotal support that we highlighted on last Friday. we also confluence with the rising 20-day moving average. But given the fact that right now it starts to have a bearish reaction after the gap down over here, and this bearish reaction took shape exactly at this former minor ascending trendline support of 6th of February, now turns into a pullback resistance level over here. So with this bearish reaction that has been formed on this pullback line of this former minor ascending channel, I do not have the confidence to maintain my bullish bias that I have seen on last Friday. So with that, I will flip to a mild bearish bias for today on the Japan 225, using last Friday US session high as my pivotal resistance level, 58,808 over here. A breakdown below 57,140 may expose further weakness towards 56,096 in the first step, which is the minor range support level that has been formed on 9th of February and 17th of February for now. However, squeeze up above 58,808 and hourly close above it, that would negate today's bearish bias, and that also cover the gap down that's being formed in today's Asia session at the start, which is at 7 a.m. Singapore time, and potentially see a squeeze up to retest the current all-time high area that was printed on last Thursday, 59,884/60,075, which is a Fibo extension level of 0.768, taken from the low of 21st of January over here. All right, so that's for the Japan 225. Onward next will be the Germany 30, represent the German DAX. So the German 30 and German DAX, which is the German DAX, represent German DAX, can't have a proper clearance on last Friday at the 25,330 before trading downwards. And in today's Asia session, based on our price action, it actually gapped down and tested the pivotal support level, okay, at 24,847 exactly before bouncing back up. So given the fluid situation right now in the Middle East over here, so I do not want to maintain a bullish bias. So I will have a neutrality stance for now and have a wait and see approach in the very shorter term. So neutral between 25,100 and 24,847. Only a clearance back above 25,100 will negate the near-term, we call it a negative feedback loop on the Germany 30 to see a squeeze back up to retest 25,225/25,330 again. All right, so that's for the Germany 30. Next will be the US stock indices, starting with the US Wall Street 30s, that's representing the Dow Jones Industrial Average. So the US Wall Street 30 broke down below last Friday pivotal support that we have at around the 48,775. It gapped down over here, but managed to find support on the 22nd of January minor swing low area over here, and also very close to the swing low of 2nd of February. So right now we start to see a bullish divergence that has been formed on the hourly RSI. So with that, given that it's still inside this messy, choppy, correct sideways range configuration since the low of 21st of January, which is this sideways range has been formed, but below the 20 and the 50-day moving average. So I will have a neutrality stance for today. So neutral between 48,345 and 49,079. So only clearance above 49,079 will negate the intraday bearish bias or the weakness to see a potential squeeze up to revisit 49,707, which is the minor swing high of 20th of February, 23rd of February, and 26th of February that got rejected previously over here. So slightly above below 49,707 will be the high that is being seen on the European session, which is also pretty much close to the 20-day moving average at 49,360. Okay, so let's put it in writing. 49,360. Okay, so it seems to be that the Wall Street 30 may be stuck inside this sideways range for now as market continues to observe the latest news flow. But nevertheless, the boost may be capped as well unless it's able to clear above 49,795 to see a short-term push up towards 49,360 before the all-important range top lower limit of 49,707. All right, so that's for the US Wall Street 30. Next will be the SPX 500. So the SPX 500 managed to see a squeeze up above the short-term pivotal support that we have on last Friday, 6,822. But however, price action still remain kept below the 20-day moving average, which was last Friday US session high at intraday high at 6,885 over here. So with that, I will adopt a neutrality stance for now, neutral between 6,885 and the minor swing low of 6th of February and 17th of February at 6,785, 6,769. So it seems to us that it's in this messy sideways range configuration since the minor swing low of 6th of February. All right, so only a clearance above 6,885 may potentially seek a retest to the upper limit of the range at 6,919, which is close to the 50-day moving average, and above it potentially retest the 26th of February minor swing high at 6,972, and also very close to this minor descending trend line since the current all-time high that was printed on the 28th of January this year. So that's for the SPX. Similar on the Nasdaq 100 as well. Now retesting the short-term pivotal resistance support level that we have on last Friday, but got rejected over here again. All right. So what we could do over here is that it seems to be stuck inside this range as well. Price action in today's Asia session managed to bounce off from this minor ascending trend line from the low of 6th of February. So thereby giving a potential configuration of a complex sideways range configuration to continue to unfold since the low of 6th of February over here. All right, there's this complex sideways range configuration, similar high, higher low. All right, it's either a ascending seems to be an ascending triangle range configuration. So with that, neutral for now between 24,627 and 25,078. So only a clearance above 25,078 will potentially see a squeeze up to revisit the potential minor ascending triangle range top over here. I think as a resistance at 25,377, which is so very close to the 50-day moving average. Okay, let me put it in writing. So it's like a zone, 25,377. Okay, 25,377 slash 25,430. All right, over here. So that's for the Nasdaq 100, and sum up all the intraday technical outlook on the benchmark stock indices. So let us now touch on the commodities market, which is very interesting, starting with the gold XAU/USD. So gold, we have a bullish bias last week, looking for the extension of this ongoing rally to continue since the low of the 2nd of February. So with that over here in today's Asia session, it gap up and it managed to form the gap close, the closure of the gap over here. Okay, and started to shape a U-turn on the upside. All right. So with that, first support level will be the gap support at 5,281, followed by 5,238, which is the minor swing high of 24th of February. Rebound, broke out on late US session, now turns into a potential psychological pullback support level. So using 5,238 as my Titan short-term pivotal support level, maintain a bullish bias for gold XAU/USD. First resistance level to watch 5,448, which is the minor swing high of 30th of January. Above it, potentially seek out 5,602, current all-time high, but also a confluence of a Fibo extension cluster level, 0.618 Fibo extension from the low of 6th of February, and a 0.382 Fibo extension from the earlier higher low of 2nd of February, making the current all-time high a very key inflection level. However, a price action breakdown and hourly close below 5,238 will invalidate today's bullish bias and see another round of minor corrective pullback to revisit 5,011.11, 5,046, which confluence with the lower limit of this ongoing minor ascending channel from the low of 6th of February, and also confluence with the rising 20-day moving average as well. Only a breakdown below 5,011.11, 5,046, that would put the ongoing rally in jeopardy to kickstart another round of minor corrective decline sequence in the first step towards 4,960, followed by 4,842. So the only scenario can take shape over here is suddenly we see a peace between US and Iran today. All right, so that could see a rather sharp reversal of this safe haven bit over here. All right, so that's for gold XAU/USD. Lastly will be the West Texas oil. So West Texas oil, before I touch on the intraday chart, let me share with you the chart on the longer term chart, which is the medium term chart on the daily chart of West Texas oil. So I could see the West Texas oil over here today, it gap up and staged a bullish breakout, and it's a significant major bullish breakout above this major descending trendline resistance from the high of 28th of September 2023 high. All right, so that's what close to about we're talking about 2.5 year plus of major descending trend line. It broke up, and that's what 73, 71.33. And today's Asia session, it covered the gap. It tried to cover the gap, but managed to find support right exactly at the pullback line of this former major descending resistance at around the 70.10 level. So that actually is pretty encouraging for the boost over here. So what we could see is if we go to the hourly time frame over here, oops, there is actually a minor U-turn that is being formed at 69.27 over here. So with that, I will continue to maintain that bullish bias that we have earlier from late last week. And also what we could see is that the hourly RSI continues to be held by a parallel ascending trendline support. So far, no bearish divergence that has been flashed out on the hourly RSI as it's worked down towards the overbought level as we are speaking right now. So first support level 69.27, using the breakout point on last Friday that managed to gap up over here, now turns into a critical pullback support, which is so the former 1st and 4th of August 2025 minor congestion area, 67.80. So 67.80 will be my short-term tighten up pivotal support level. Maintain that bullish bias for its ongoing upward trajectory towards the next resistance level, which is at the 19th of June 2025 minus swing high, 74.70, 75.55. We also confluence with the 2 times Fibo extension taken from the low of 17th of February. Above it, seek out 78.10, which is the 2.618 Fibo extension. Then thereafter, potentially, if 78.10 breaks up to the upside, it will come into the medium-term swing high of 15th of January at $80.30, which is a psychological, very important level for West Texas crude oil. So anything that's above $80 per barrel, that could increase inflation expectation going forward. So however, if price action can't maintain above 67.80, then the only reason price break down 67.80, which is a sudden peace stop breakthrough between US and Iran, and that could potentially see unwinding by short-term speculators on the long side for profit taking, and even long, we call it net long covering, to bring the oil prices down lower towards 64.80, which is the rising 20-day moving average, followed by the region between the 200-day and the 50-day moving average coming at the next support at 63.10, 62.05. Right, let me put this in writing. So that will be 64.80. And a zone of 63.10. And 62.05. All right, over here. So if price action indeed starts to float down between 64.80, 63.10, 62.05, I'll be on the lookout for a bullish reversal candlestick again, given the fact that we are now in the midst of a medium-term uptrend potential for West Texas oil, given its swift clearance above these key moving averages, 20, 200, and the 50-day moving average going forward over here. So that sum up today's intraday technical outlook on the broad-based cross asset classes. And bear in mind that the geopolitical factor are always rather fluid and unpredictable according to news flow. So in my own opinion, I'll be taking a close watch on those key levels that I mentioned earlier on these cross asset classes, and we'll take things one step at a time. So before we go, other than this ongoing US-Iran ongoing conflict that is playing out, let us take a look at the economic calendar. What are other key data to look out for today? So today we see a series of, so let me take a look at it. So today will be Monday. So Monday, during the start of the US session, there's nothing interesting. Okay, at 8:30 p.m. Before the start of the US session, we have Australia RBA official speaking, RBA Hunter, which is, if I'm not wrong, he's the deputy governor over here. So his weight may say his speech may have an influence on the Aussie dollar and the Aussie crosses. And at 8:30 p.m. we have a BOE official, Bank of England official Taylor speaking. And at 10 p.m. you have ECB President Lagarde speaking. So both BOE at 8:30 p.m. potentially could see some form of minor movement on the cable versus the USD, and at 10 p.m. with the speech of ECB President Lagarde could potentially influence the euro dollar and the euro crosses. And very important will be the ISM manufacturing PMI data. So that could influence the major stock indices as well. So that will be at 11 p.m. Singapore time for the month of February. So market participants expecting almost unchanged. Previously was 52.6. And market is expecting at 52.3, so that should be that is almost unchanged. So unless we start to see a very low ball number like 51 or even 50, then that could have a negative feedback look back on the major US stock indices. Then nevertheless, that will be it for the US session over here. And at 5:10 a.m. Singapore time tomorrow, we have RBA Governor Bullock speech. So that could influence the Aussie dollar at the start of tomorrow early Asia session before our daily dose kickstart at 11 a.m. Singapore time, so that 5:10 a.m. So with that, let's sum up today's rather quite long daily dose due to this ongoing US-Iran conflict that could have a rather choppy, volatile intraday movement on the broad-based cross asset classes. So with that, I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.